Hey everyone, Brian Bogner and Greg Towner here. And it is, of course, time for our monthly podcast, the 20-minute market breakdown. Say that as many times as you can in a minute, 20-minute market breakdown. So we're going to take the next 20 minutes and talk to you about our views, our thoughts on the economy, on the market. We just dive a little deeper into some things that we think are important for you to know as you are navigating through these fun times that we live in right now. So let me throw it over to you, Greg. We always like to start just kind of with a bit of an anecdotal story. Just, kind of how's life going? How are things going?
Yeah, thanks, Brian. Things are going great. Enjoying fall weather here in the Southeast. I think most people probably are. I think what's one topic that people have loved to talk about in recent years, real estate, right? Particularly
Right.
local real estate, what's happening. You talk to your neighbors about what's happening in your neighborhood. So we all love an anecdotal real estate to shore up what we're seeing in the data. So what's going on in our neighborhood? We live in a, kind of a historic neighborhood near downtown Raleigh. Back in the spring, we rarely have had homes come for sale, small neighborhood. Back in the spring, we had 3 homes come on the market right within about a month or two period when things were still going pretty decent. Mortgage rates were still fairly low. They sold almost immediately for asking, or, one of them was well above asking. So it kind of kept chugging along. But then a couple months later, beginning of the summer, a 4th home came on the market right near those 3, at least as nice, if not nicer than all the others. It's still for sale. They've had about 5
Wow.
different, price reductions now. And it's, nice home, pricing was in line with everything else. They weren't asking something insane compared to what had been occurring. So, even in this kind of neighborhood, which historically had been popular, seeing the slowing that I know, people are seeing elsewhere and we're seeing in the data. So it's just kind of interesting to see that up front.
Yeah, it is interesting to see things firsthand,
Yeah.
whether it's in our backyard or whether it's in other parts of the country. Last
Yeah.
week, I spent the week in the great state of Texas, where
Hmm.
truly everything is bigger. There is no doubt in my mind. Flew into Houston, had some meetings there, rented a car, drove over to Austin, had some great meetings there, and then back to Houston. Food was great. People were really nice. But a couple observations. First one was everything continues no matter where I go. And I've been out west. I've been in a couple of weeks here. I'm heading down to Florida for some stuff. So I'll be interested to see what's going on there. But I continue to see everything is packed, right? Because when
Hmm.
I'm traveling, I'm
Yeah.
not eating at home, right? The hotels are packed. I mean, I remember a couple of nights at the hotels. I asked for the upgrade option. They're like, "Sorry, sir, we're completely booked." And it's a weeknight, and
Yeah.
the restaurants are packed. Everything, the plane flights over and back, packed. So it's like I keep hearing about this recession. Keep hearing about this recession. Recession's coming, and it may very well be coming. But right now, people are spending money. One of my meetings there, quite interesting, was with a payroll company,
Hmm.
and they're a PEO. They do payroll for 28,000 employees. So
Okay.
different small companies, they kind of all band together, and then this group does their payroll, and they're able to get better benefits, things like that. But they said, like, all their business owners that they talk with, all the folks, they said the issue's not like, oh my gosh, we got to start laying people off or we got to hunker down. They said they're not even getting an inkling of that. And,
Wow.
and their clients are all over the US. They said
Yeah.
their number one message is all of these people they deal with, no matter the industry, it's like, we're backed up. We got to fill things. We got to get things out. We got to move things. We need people. We need
Hmm.
people. We got to figure out, how do we hire? How do we improve our benefits? How do we retain who we've got? And how do we attract more talent? They said by far that continues to be the message that they got. So,
Wow.
we read headlines all the time. These things don't always some of these things make headlines, but not all the time. And I think sometimes these things that we experience firsthand are quite profound. All right. So today, what we're going to be talking about is the normalization of our economy and our market. And let's talk a little bit about what that means of getting back to normal. Because when I talk to clients, when I talk to people, I think there's this idea of like, well, we look at the last 5 to 10 years of how the market was, and things are changing, and the market's going down, and all these things, and interest rates are going up, and all this stuff is happening. And I think there's this idea of like, well, we got to get back to that.
Right.
And we've been saying this for a while. And I think we just really need to hammer this point in. We need to really flip that whole thought upside down. The last 5 to 10 years was not normal.
Right.
It was not, it was the outlier. we are now getting back to normal levels. We're now starting to move in the economy and the market back to levels that over history, over long periods of time, is where we were at. Your thoughts?
Yeah, I mean, obviously the pandemic changed things in a lot of ways for all of our lives, but also for the economies worldwide, for companies and how they do business and supply chains and everything, just completely distorted things. But as you said, I mean, you got to go back even before that. It's not just the pandemic. I mean, you could probably go back to the financial crisis when quantitative easing started and
Right.
kind of a lot of this artificial liquidity pumped into the markets. Everybody just kind of felt like this was the new thing. And it was for quite a while. But now some of that is shifting, both the normalization coming out of the pandemic and also the normalization of what the Fed is doing. The Fed didn't always come to the rescue every time there was a little blip in the economy and automatically pump liquidity. In
Right.
fact, so now they're doing the opposite for a variety of reasons. We'll get into that. But I think you're right. It's things feel bad and things are bad in some ways and good in other ways. But a lot of it's just getting back to so-called normal. There's not much normal in the world right now, it feels
No.
like. But the financial markets in their own painful way are trying to get to a so-called normal. And I think it's important for people to be aware of that and for money managers to certainly be aware of it as well.
Well, let's talk a little bit about interest rates and fixed income
Yeah.
because I think, as we know, the Fed drives short-term rates, which then can drive long-term rates, which really drives everything, right? Because you've got to typically borrow some money to go do the things that you want to do out there. Um, and I think this is a great example of this. Is that for so long, right? Especially coming out of the financial. This is going back to the financial crisis back in '08. um, Rates really have been artificially held low. And
Yeah.
not only, I mean, extremely low. And not only here in the United States, but around the world. Like rates here were close to 0%. Around the world, you had interest rates at negative levels,
Right.
meaning you're paying that government to hold your money. It made no sense at all. Again, really absurd to create all this liquidity. And now that's changing, right? And so interest rates are going up, and that's affecting a lot of things, right? People's ability to borrow money now, their carrying costs are come higher. But let's talk a little bit about it from an investor standpoint, right? Fixed income just hasn't necessarily been a great place to look to because the yields have been so low. Well, guess what's happening? Yields are starting to move higher now. Things are starting to move up. That this area of the market is starting to look a little more attractive than it has in recent years. I think most people are still scared of it, but it's quite interesting that we're now talking about fixed income as a
Mhm.
real viable asset class to hold because of the higher rates there. Thoughts?
Yeah, I mean, I think people are a little bit afraid of it because of what's happened to fixed income here this year. I mean, if you look at kind of a normal 60-40 portfolio, 60% stocks and 40% bonds, it's the worst year in history because
Right.
normally when stocks do poorly, your fixed income, your bonds tend to hold up well and kind of smooth things out. That has not been the case this year with the dramatic increase in speed and the rates going up. And so people look back as to what's just happened and think, oh, I can't own bonds. And we have not been, very, enthused about bonds for years here. We're starting to get more interested, as you said, because now the higher starting point for the bonds, normally historically, if you look at the starting yield for bonds, that's more or less what you're going to achieve in return over the longer term if you're holding them, for the longer term. And so you're getting a better starting point. I mean, I wouldn't say they're incredible. They certainly could go
Right.
higher. They're not some table pounding, everybody needs to be all in on bonds, but you can more easily justify them as part of the portfolio. Anywhere from the short-term cash is offering rates to the kind of the short to intermediate term bonds is now as part of a diversified portfolio, they're more attractive.
One of the things that fascinates me, and we look at it every year, we know it's there, but it's so easy to forget, is we put out our periodic table of returns, and it
Right.
shows each asset class. Well, invariably what happens is when you have a year or two where one particular asset class is up at the top, usually that shortly thereafter, it's at the
Right.
bottom. Vice versa. You might have a
Right.
few years where that asset class has kind of been a year or two where it's on the bottom. And then what happens? It flips to the top, and then you have some that are kind of in the middle. But I wouldn't be surprised. I'm not making a prediction, but I wouldn't be surprised that as much, if this is going to be one of the worst years on record for bonds, over the next year or two, I wouldn't be surprised if we saw bonds be a decent asset class to be in, just based on that. And again, we don't make predictions here, but we do like to use history to kind of look at things going forward. Let's talk a little bit about, you mentioned about real estate. I think in this market, real estate just kept going up. Didn't matter where, throw a rock, hit a house. It's 20, 30, 40% higher than it was a year ago. Okay. That's clearly changing. And again, and I think we're going to be saying this a lot during this podcast, the fundamentals of the market are now starting to play, right?
Right.
Location. Where are you? What's the job situation like? What are property taxes like? What are these things going on here? Are the schools good? Remember all those things that used to matter that really hadn't mattered? And last year it was just like, oh, it's a house. It's in a cool area. Boom, buy it, done, go,
Well, I mean, it was obviously the pandemic did some of that, but it's back to the interest rates. When you have cheap, seemingly free money, every asset class, can go up in price. Yeah, maybe at different rates, but they're all moving in the same direction. And that was the same with real estate. And we think, back to normalization, we think that is normalizing as well now. Yeah. For all the factors that you said. And so it's going to be more localized and more, areas that are doing well, some that are doing poorly. It's just another aspect that is being driven by this normalization. And underneath that is probably the emphasis on interest rates is driving a lot of it.
So, and let's talk about stocks. I mean, I know I wanted us to focus a little bit on fixed incomes because we rarely talk about it. We talk about stocks, but I think we can say the same thing, right? I mean, you just buy the dip, everything goes up. Now, some things go up more than others, but everything was going up. You own stocks, you're high-fiving, having a good time. But what's happening now, right? The normalization, it's kind of getting back more to fundamentals and things like that. Kind of an interesting stat I read recently because, I think we can all agree over the last 10 years, the stock market was fueled mostly by technology related and consumer related stocks. That was really driving it. Well, guess what? Year to date, okay, the decline in the S&P, I don't know where it is. Is it 20 something percent right now down for the year? 40% of that decline you can attribute to technology. Another 18% to communication services, which guess what? That's Facebook, Twitter. That might as well be technology, right? So there's close to 60%. Add in consumer discretionary, right? Which is, again, all the stuff we're ordering online right now through Amazon and everything, whatever. That is 76% of this decline you can attribute to three sectors, and the majority of that being technology related. So if you really think about this decline this year, there's 11 sectors in the S&P 500. The ones that were really pushing them higher are the ones that are really dragging it down. So yes, stocks are down and things are happening, but what are we seeing now? The market's starting to work itself out now. Not everything's down. There's other areas that, there's finding good value and things like that there. So your thoughts?
Yeah, I mean, I think the normalization there is back to fundamentals. The fundamentals matter. Before it was just, if you go back to the beginning of our career in the internet tech bubble, it was eyeballs. How many eyeballs could you get on your website or something like that, right? And so we've just kind of had another version of that now, whereas money printing helped all these companies come public and grow with no earnings.
Right.
And so now, as liquidity is drying up, it's back to the fundamentals, which we love. That's the way we manage money, high quality investments. And so it's not going to always be that way. That value isn't going to always be going up and growth down. Of course, there's going to be different periods, but we think it's going to get back to, it already has gotten back to the fundamentals mattering from a business perspective and from a stock perspective as well, from a market perspective.
And comment real quick about, we've talked rates, we've talked bonds, we've talked stocks. Let's touch inflation real quick.
Yeah. I mean, how could we not talk about inflation when we talk about normalization, right? Because it was so low for so long for a variety of factors. And now for the last year plus, it's been abnormally high. We all know the pain of that. The Fed is trying to get it back down to an extremely low level where it had been. I mean, I think that's going to be difficult. I think they're going to have to accept getting it back to a new normal, a normal that maybe long-term was viewed as a normal rate. But over the last decade or so, we didn't achieve that. So I think if they can get inflation down, maybe in the 3% area, that ultimately will be a comfortable normal for everybody.
Mhm.
I'm getting it back down to the 2% that we've seen for the last decade or so. That's going to be a challenge, and there might be some pain to get
Yeah.
there.
Yeah, we may not. The
Yeah.
reality is we just may not. All
Yeah.
right. We're getting close to 20 minutes here. So why don't we go ahead and wrap this up? I know we like to just kind of wrap it up with some things from each of us. Greg, why don't you go first, and then I'll close this out.
I have a couple of easy ones here, and this first one is super simple, but I don't
Mhm.
think enough people do it often enough. Great weather here this fall right now.
Mhm.
Everybody needs to get outside, away from their screens. We're all spending too much time on our screens.
Yeah.
For the mental and physical benefits of go for a walk
Yeah.
in your neighborhood, at a park, wherever. Doesn't have to be an hour walk. It could be 10 minutes, 2 or 3 times a day. Just, I know it seems simple, but I think we all just, get distracted or get busy and don't do it enough. So
It's a good
get
word.
out there and go for a walk. And the other thing, there was a quote recently. This gentleman, Stephen Chazen, passed away recently. He had years ago was the CEO of Occidental Petroleum, and he had a quote that I thought was great and relevant to investing. He said, "Never invest in a company that makes less money than you do as an individual." Right. So don't invest in a company that has no profits or makes less
Yeah.
money than you personally do. Right. So that's kind of, if you think about how people invested, so to speak, the last few years buying these speculative, companies with no earnings, they were buying stock in companies that they personally, their own personal income was more than those companies. So just I thought that was an interesting way of looking at things, and people could have probably done a lot better if they didn't chase those types of stories over the last handful of years.
Good stuff. Good stuff, Greg. All right. I got two things here real quick. First thing is, you know, we've talked a lot about this normalization. I think it's important to what are we doing? What is Parallel Financial doing?
Yeah.
Just to share just a snippet of that with you. Over the past couple of years, just like we talked about how tech was feeling this, and we started to see some weakness. We started reducing a lot of our tech exposure and increasing more value oriented holdings here over the last couple of years. We've also added exposure to other themes, infrastructure, water, things that we see long term issues in our society and in our economy with that we are investing in. This year, we took advantage of this downturn, and we did some significant tax loss harvesting in our tax loss harvesting in our clients' accounts to take advantage of some of these losses and put them in a better tax situation. We're utilizing cash, and we're utilizing some things in cash as an asset class and getting a better return and parking some money there as well. And most importantly, we are sticking to our rules-based plan. Okay. So you can't just let emotions drive your investment decisions. So, if you're a client of ours, and I know if you've been meeting with us, we've been talking you through this stuff. If you're not a client of ours, we'd be happy to talk you through it. Or if you have another advisor, make sure they're doing this stuff as well, because it's really important in the times that we're in. And I'll close out with this. Um, as we, as we start the last quarter here of 2022, I would just encourage you, this next season here is a great season. If you have not done any type of charitable giving or charitable involvement or something like that, this is really a great time to maybe identify whether it's in your backyard, in your community. There are great organizations out there that are looking for people. A lot of times think, well, I have to have a lot of money and write a big check. Trust me, you don't. They're just looking for people to either get involved, give whatever they can. You can give time, you can give resources. There's a lot of things that you can give, and I can guarantee you there's a organization in your backyard that shares a passion that you have for your community. And so I would encourage you to do that. I mean, we just, I mean, if it's not in your backyard, we just had a hurricane rip through Florida right now, and there's a lot of really good folks down there dealing with a lot of stuff beyond their control. And there's some great organizations that are down there right now on the scene, giving food out and doing all kinds of stuff you can contribute to. So as we get into this next season, I would just encourage you to look at some areas, if you aren't already, and participate that way. So Sounds good. Looks like we have hit the 20-minute mark right on the dime, which is great. I want to thank you all for listening. If you have any questions at all, you can reach us here at parallelfinancial.com. Give us a call, shoot us an email, and we really thank you for your time today.